Well, good afternoon, everybody. Alex Fenske here coming to you. Oh, good afternoon, everybody. Alex Fenske here coming to you with your April market update. We're going to cover data from the month of March. We're going to cover data from the first quarter. We're going to talk about mortgages and the mortgage market. And we're going to talk a little bit about projections, about where we're headed from here. There is some seriously weird stuff going on in the market in terms of what's driving it and what it's doing. So we're going to interpret what we can, and we'll do that here. So I'm going to dig in on it. I'll be watching the chat. If you have questions, go ahead and drop them in there, and I'll keep an eye on the chat. Hey, Molly, how you doing? As always, the idea here is for us to not just go through the information, but what it means. Have you walk away with a couple things you can say to your clients, a couple of informed little factoids that you can relay easily, and then talk about what actions you can be taking to build the best business you can in the current market conditions. So that's what we're going to go through today. Make sure that it's useful for everybody here. First thing we're going to talk about is the number of new listings, and we're talking about that first because that's the number that has changed. For most of the hey Perry, how you doing? I see you, man. For most of the pandemic here, new listings have been down year over year, but not by much, single digits. 8%, 6%, 9%, not that big of a difference. They're down quite a bit now. In fact, if you look at the first quarter of 2022, the number of new listings that came on the market in our multiple listing service, and I'm talking about all single family attached and detached homes, it was 14% fewer than the first quarter last year. And if you remember last year, first quarter, that was lower than the year before it. So we're actually down 14% new listings compared to last year, first quarter, which we're down 22% compared to 2020, 24% compared to 2019. So compared to the last normal year we had before all of this COVID craziness, there's a quarter of the listing pie has been taken out. So if you're finding it more difficult to find listing leads and listing opportunities, that is a fact. That is a matter of fact. There are not as many of them out there right now. So the new listing pie has definitely shrunk for the time being. We're going to talk about what to do about that. That is a true fact right there. New listings are down considerably now. At the same time, I'm going to look at buyer activity, which we measure by pending contracts. And the number of pending contracts, believe it or not, was actually down compared to last March, and down compared to last quarter. To the first quarter of last year as well. Down 11% March over March, down 10% for the quarter. So what does that mean that the number of pending contracts are down? Many of us believe that this is because of the restrictions posed by the limited inventory. That there is what we would call pent-up demand, meaning if there were more listings available, there would be more contracts. So if you're listening right now, do you think that's true? Do you think if there were more listings available right now, do you think there'd be more contracts? When we're dealing with multiple offers on each listing, you have to imagine that that's the case. If there were 3 more listings, we'd probably have 3 more contracts. If you had 26 offers on one listing, right? So that seems truthy to say that buyer contracts are being restricted by the lack of available inventory. Nevertheless, contracts are down. As an agent, when you're looking at your business plan and you're looking at your cash flow, and we just said that not only new listings are down, but pending contracts are down too. Just not as many deals happening right now as there normally are right now. We are, though, with pending contracts, we're actually up 13 to 14% over prior normal years. So there's more contracts than there usually were, just not as many as last year. And we do believe, in summary, for pending contracts, that they're being held back by the lack of inventory. And that's our third metric we're going to hit is inventory, the number of homes available. That is probably the most notable new thing or change that's happening in the marketplace right now. Is that every year with let's take a step back. In general, our seasonal housing market patterns are extremely consistent and predictable. I mean, you can take a look at all sorts of different metrics, and if you look at the annual view of them and you look at the monthly data points over the course of several years, and they go up and down and up and down. It is like rock solid consistency year in and year out. Our seasonal patterns are very consistent. COVID broke our typical seasonal patterns starting in March of 2020. They began to return, but now inventory is changing again. Uh, December is always the month where there's the fewest homes available. There's the fewest active listings in December. Then you typically see an increase in February and another, in January and another in February. And the inventory levels go up each month until you get to August or September. They peak every year in either August or September. Never any other month. August or September is when inventory peaks. Rock solid consistency, right? Well, December, sure enough, December 2021 was a low point. In fact, it was a record low housing inventory number for our multiple listing service. Fewest homes available ever. And in January, instead of that number going up, it went down. And in February, instead of going up, it went down again. And in March, despite all the conventional wisdom and seasonal patterns that say, oh, lots of listings are going to come on the market in March, no, it went down again. Because remember, we're still at elevated buyer demand compared to normal years, and we're now at lower supply than normal. So combine those two, and the amount of inventory is actually just going down and down and down. We've now hit 4 consecutive months of all-time record low housing inventory in our MLS. And that's weird. That's very weird because typically this time of year, there's more homes coming on the market and there's more available to choose from for the buyers. And typically March, April, and May are the 3 biggest contract months. And I'm not so sure it's going to play out that way this year. So let's talk about pricing. Let's talk about what that's done to pricing. We could get into a lot of different things, and pricing, of course, is a local issue, so it's going to vary a lot from town to town and county to county and metro area to metro area, even inside of our MLS. But here's what I want to point out. That pricing is determined by housing supply. And I mean the metric housing supply that factors in the number of listings available and the number of buyers buying them. So our housing supply metric is the one that factors in essentially all the other ones. And it's supply that dictates what happens with pricing. If you're in a seller's market with housing supply less than 6 months, you're going to see upward pricing pressure. If you have 5 months of supply, a little bit of upward pressure. If you have 1 month of supply, a lot of upward pressure on prices. If housing supply is more than 6 months, it's the opposite. There will be downward pressure on prices. At 6 months of supply, your pricing should remain pretty flat. So here's what happened last year, February 2021 through June 2021. During that 5-month time period, housing supply in our MLS hit a record low of 1.7 months, and it stayed there through that whole time frame. 1.7 months of supply, all-time record low. Now, what did that do to pricing? There was if you look at the charts, there was a huge spike in pricing from between last February and June. It was because of the 1.7 month housing supply. The median closed sale price during that stretch of time went from $255,000 to $300,000 in 5 months. It was a 17.6% increase, not annualized. 17.6% in 5 months. Annualized, it's like 40%. That happened last spring because of 1.7 months of housing supply. Right now, housing supply sits at 1.1 months, a new record low, and not by just a little. So my question for you is, what do you think is happening right now, right under our noses, when we were going to start seeing the closed sale prices of homes that are closing right now, that are going under contract right now, that are going to be closing in April, May, June? What do you think is happening with pricing as we speak? It's probably going up like crazy. Now, a lot of people would say, well, what about mortgage rates? Those have come up a lot, and they have, and we're going to talk about those numbers in a second here. Mortgage rates should have a cooling effect on some of this, but now the mortgage rates going up has to fight the fact that inventory is at an all-time record low and new listings are shrinking. So how much is the mortgage rates going to offset that? I heard a story recently about a listing that came on the market for $425,000 in our area right here near the office, and the uh, the agent called the listing. Our agent called the listing agent, says, "Hey, we want to come in at 450 cash. I know you got multiple offers, but that's a good offer, right?" Listing agent says, "Hey, I don't want you to waste your time. I wouldn't bother writing that up for 450 cash, because what ended up happening is they had an offer already on the table that was 470 something, with an escalation to over 500 cash. Why? Because the buyers were living in a hotel. They'd been through this enough times. Their lives had been horribly sidetracked, and they were desperate. And right now, when you're talking about fewer homes available than ever, and that worsening and worsening, it's whoever's the most desperate is going to get the property. So you can take a lot of these notions about comparable sales and things off the table when there's someone like that. That's willing to do just absolutely anything to get the home. So yeah, mortgage rates are up, but not all other things are still equal. It's actually that the inventory situation is getting tighter and tighter and tighter. So the rising mortgage rates, I don't know that they're going to have as much of effect as they would have if supply levels had remained consistent. So that's the summary with pricing. Is I think right now, when we look back at these, the current time period in the next couple of months, I think we're going to see another huge increase in pricing. Now, with that said, let's touch on mortgage. So mortgage on January 1st, and I get my mortgage data from the St. Louis Fed. All my housing market data I get from InfoSparks, which is a data affiliate of our multiple listing service. So those are my data sources. So St. Louis Fed says that on January 1st, the 30-year fixed rate mortgage was very consistently averaging about 3.1%. This week it's averaging 4.67%. That is a massive increase, and we told you that was going to happen back at the January and February market updates when we were talking about the Federal Reserve Board's actions as it relates to their asset purchases, which are now pretty much over. So that's like over a 1.5%, a 1.5 point increase in mortgage rates just in the first quarter alone. And about half of that jump came in the run up to the Federal Reserve's March meeting, where they were going to raise the target rate. They were going to announce that they were pretty much done with asset purchases, buying mortgage-backed securities and treasury bonds. And that happened, and they made some aggressive statements that they're probably going to need to raise rates even more or more frequently, or both, than what they were thinking ahead of that, which then caused the rest of that increase to happen. And now we're sitting 1.5 points higher. I just want you to remember two things as it relates to mortgage. Number one, the federal funds target rate that they talk about, raising it a quarter point, that does not equate to mortgage rates. Mortgage rates are a market. It's a market based on trades. It's the Federal Reserve does not dictate mortgage rates, not for this type of mortgage. Now, a lot of other loan products like home equity lines of credit and things might be tied to an index like that, whether it's the Federal Reserve target rate or LIBOR, the London Interbank Offering Rate, which is their equivalent of the Federal Reserve. A lot of like revolving lines of credit are tied to that stuff, but not your 30-year fixed rate mortgage. So that happened, all right. But number one, federal funds target rate does not determine mortgage rates. Number two, mortgage rates do not determine home purchasing activity. It does have an effect, but people don't buy homes because mortgages are cheap. People can pay more because mortgages are cheap. They can pay a little less because mortgages are expensive. But it doesn't mean that your family of five in a 2-bedroom condo is not going to do everything they possibly can to buy a home. They're still going to do that. It's just going to change the way that looks a bit. That is my mortgage summary. So now we've hit real estate market metrics, we've hit mortgage market, and now I'm going to go on to what the heck do we do about this? So there's weird stuff going on. It makes our jobs harder. What do you do as an agent in order to do your best and serve your clients the best? Well, number one, you can educate them on this and hit these main points and these summaries that I've given you. Give them the little sound bites about the new listing pie shrinking. Give them the sound bite about demand being being restricted by the lack of supply, about the four consecutive all-time record lows in housing inventory. Tell them that stuff. Tell them about the mortgage rates and how much they've come up, but the fact that they're still historically extremely low, not just kind of low, extremely low historically. And and here's the number one thing that I would tell your clients, especially your buyers, because right now a lot of people are having trouble with buyers because there's the inventory situation. A lot of buyers seem to think they can buy in the past. I've watched some pretty interesting movies lately about stuff like that, but I have yet to hear about anything in real life where you can buy yesterday, where you can buy a house last year. You either did or you didn't. You can't buy it last year, so you can't compare your pricing and your payment to last year. You can't do it. I mean, you can, but what's the point? All you can do is buy today or tomorrow. Those are the only options you have. You can buy right now or you can buy later. And here's what I'm telling our clients is that it's certain that housing prices are going to continue to rise for the foreseeable future because of these market metrics. Number two, it is certain that mortgage rates are going to continue to rise because of the Federal Reserve's actions as it relates to their net asset, what was purchases and now is starting to be sales. They're going to start selling off all that stuff they were buying. And it's going to continue pushing up mortgage rates. So if rates are going up and prices going up, and your only chance to buy is now or in the future, well, it's more affordable to buy a home right now than it's going to be in the near future. That's a fact. If they want to wait it out, they might have to wait years. The same as you may have told a seller in 2008, 2009, 2010, hey, listen, if you can't afford to sell right now, you can wait, but don't think you're going to be waiting 12 months. You might be waiting 7 years for another market cycle. And if that's okay with you, great, that's fine. But don't let people think this is going to be significantly different within the next 12 months. It doesn't seem that any experts think that. It will change. 100% certain it will change. It's going to have to change a lot before it really impacts the bottom line like this. So number one, I would educate your clients. Number two, behind the scenes, how do we work with this as an agent to do our best to stick with our business plans and increase our production, not decrease? Well, let's get a couple facts out there. Number one, it has never been easier to get a signed listing closed. Once you have a listing, it's never been easier to get to the closing table. And I'm not talking about contract cancellations and stuff. Those do seem a bit high right now, but I don't have data on that. I'm just talking about once it's signed, I mean, there's so many people out there to buy it. You're going to end up at the closing table almost 100% sure. So that's a great thing. Number two, we do have data on this one that it's actually never been easier to get a listing signed once you're at the table. Once you're at the kitchen table, a record high number or record high percentage of sellers are signing with the first agent they meet with. So that's great. It's never been easier to get a listing agreement signed once you're at the table. And then once it's signed, it's never been easier to get it closed. This is all great news. So the catch is that the new listing pie is smaller by about a quarter. So it's like you show up for Thanksgiving dessert and the pie's there, but a quarter of it's been taken out. You know, whoever, the chef, like in the kitchen, decided to entitle themselves to a little chef's take. And they took a quarter of the pie out. And now the pie's on the table. It's smaller than it's been in recent years. And by the way, there's more people at the table fighting for that pie than there ever have been because NAR membership is at an all-time record high as well. So you got a smaller pie and more people fighting for it. How do you get the same amount of pie? Well, you can't just do what you've always done because that's going to get you a proportionate share of what there is. And remember, what there is 25% smaller. So if you do the same thing, aka you make the same number of contacts, you do the same activities for lead generation that you've done in recent years, your business is probably going to shrink by 25%, maybe more. That's what's probably going to happen. If you want the same amount of pie that you always get, despite there being a smaller pie and more people fighting for it, you're going to need to do more. Now, what I didn't say was different. So take note of this. I didn't say you're going to need to eat the pie with a spoon. I didn't say you're going to need to have whipped cream or you have to have a bib on. I didn't say you're going to need to eat the pie different. It doesn't matter how you eat it. It doesn't matter. I don't care if you got a spork. Sporks are great, but it doesn't matter if you have a spork. You have to get to the pie first. You have to work harder faster. You need to make more contacts. You have to have more two-way conversations. You have to have more prospecting and more marketing than you've ever had to get the same number of listings. I'm sorry if that's deflating. This is a temporary thing. It won't always be like this, but you're going to have to invest more time, energy, possibly money. You're going to have to work harder to get the same number of listings because there aren't as many to go around and there's more people fighting for them. So here's the question I'll leave you with. Given that the new listing pie has shrunk by about a quarter, and if this continues, that number is going to increase. The question is, in what ways will you specifically adjust your schedule and your activities to increase the number of people you talk to about real estate by 30% or more? The answer to that question and your follow through on the actions are what's going to determine whether you increase your market share right now or whether you keep a proportionate share of it and your business shrinks by a quarter or more. Again, that question is, what specifically will you do to increase your lead generation activities and time spent by 30% or more? Start right away. What are you going to do? If you need help with that, feel free to reach out. Remember, it's not necessarily about creative and different. It's just about more. Sometimes quantity begets quality, and this is one of those times. You got to be first to the kitchen table, and there's fewer kitchen tables, so you're just going to have to get out there, talk to more people, get more messaging out there, remain seller focused, and counsel your clients on on what's going on with the market. With that, that's the end of my report. I'm keeping an eye on the chat here for any questions that you guys have. I know I threw a lot of information at you. Hopefully you're getting the sound bites, the tidbits. New listing pie shrinking. Demand is elevated over normal years, but is restricted by restricted by inventory, which is now at a fourth consecutive all-time low. Mortgage rates are going up fast, and it's going to be more expensive to buy a home in the future than it is today. Those are the main points here that I think are helpful for you to bring back to clients. Well, that's me killing time for a couple minutes looking for questions. I'm not seeing any. If you have any after this, feel free to reach out, drop them in the chat, and we'll get all your questions answered. I wish you luck in the spring real estate market 2022.